You can start investing with just $500 by buying low-cost index funds with zero fees. Here's the problem. 80% of Americans wish they'd started earlier. In this video, I'm showing you the exact step-by-step process to get your first $500 invested in 2026, how to avoid fees that destroy small accounts, and why simplicity beats trying to pick winning stocks. Let me start with the math that should convince you to act today. If you invest $500 right now and never add another dollar, that money grows at the S&P 500's average return of 11% per year. In 20 years, that single $500 investment becomes approximately $2,839. But here's what makes this urgent. The average American doesn't make their first investment until age 27. If you're younger than that, you have a huge advantage. If you're older, every year you wait costs you thousands in compound growth. According to the SEC, starting early and investing consistently in diversified plans is the foundation of financial independence. The financial services industry used to tell you that you needed thousands to start. That's completely outdated. In 2026, you can get started with less than $500. Your first decision is picking where to open your account, because your broker determines how much of your $500 actually goes to investments versus fees. 15 years ago, brokers charged $5 to $10 per trade. Today, that's gone. Every major broker offers commission-free trading. The three brokers that are best for $500 investors are Fidelity, Vanguard, and Charles Schwab. All three offer zero commission trading and no account minimums. Here's what sets them apart. Fidelity offers the Fidelity Zero Large Cap Index Fund, or FNILX. The key word here is zero. Zero expense ratio, zero minimum investment. You pay nothing annually to hold this fund. That matters enormously when you're starting small. Vanguard and Charles Schwab offer similar low-cost options. Pick whichever one feels easiest to use. The differences between them are minor compared to choosing the right investments. Here's where most beginners go wrong. They get paralyzed trying to pick individual stocks or chase the latest hot sectors. With $500, that's a trap. The data is overwhelming. 92% of active fund managers underperform the S&P 500 index over any 15-year period. This doesn't mean those managers are bad at their jobs. It means beating the market consistently is nearly impossible, and their fees make it even harder. You should put your entire $500 into a single low-cost index fund that tracks the entire U.S. stock market, an S&P 500 fund or total market fund. That's it. One investment, one simple decision. This approach gives you instant diversification across hundreds of companies, and you pay almost nothing in fees. When you're just starting out, simplicity is your biggest advantage. Here's the brutal math of fees on small accounts. If you pay a $10 annual maintenance fee on a $500 account, that's 2% of your capital gone before any market gains. If you pay $15 in transaction fees to buy stocks, you've immediately lost 3% of what you're investing. These numbers might seem tiny, but they compound into thousands in lost gains over decades. There are 4 categories of fees to avoid. First, account maintenance fees, annual charges just for holding an account. Skip any broker that charges these. Second, trading commissions. All major brokers eliminated these, but some discount brokers still charge them. Third, high expense ratios. Avoid anything above 0.10% annually. That's where funds like Fidelity's zero expense ratio option shine. Fourth, advisory fees, which brings us to robo-advisors. Robo-advisors charge 0.25 to 0.5% annually. They sound convenient, but with only $500 to invest, you don't need them. You'll get the same index fund exposure by buying directly with zero advisory fees. The full article walks you through the exact step-by-step process to open your account and make your first trade in 2026. There are also more specific fund recommendations and sources linked below. If you found this helpful, subscribe for more grounded personal finance content that cuts through the noise. Read the full article at wealthwire.com.